You have done 1031 exchanges in here? Yes. Oh, you have? I'm sorry. Anybody else? Okay, this is definitely something that you need to know about. Both as a facilitator and a trainer. He has facilitated over 300 exchanges. He has trained over 1,000 real estate professionals, consulted with over 1,000 investors, including their trusted advisor teams, and served on multiple Realtor Association boards. His unique training style is unmatched. He takes potentially complicated issues and presents them in an easy-to-understand, engaging delivery. Welcome.
Wow, thanks a lot. Thanks a lot, Kristin. I want to live up to that. That was pretty nice. You guys have seen this game before, right? Yeah. I'm sure everybody's played that. How well do we do when we play this game? Pretty good? Especially if we're experienced in real estate? Okay. So one of the things I'll leave this out here for is I kept seeing real estate investors basically playing that for real, over and over and over again. And what Julian said about what he's talking about is absolutely accurate, because all of these things are tools. We use them when they make sense for us to get us to the next level, whatever that means. What I like about all this is you can start at any position you want. Brand new investor, seasoned, whatever. It all makes sense at some level. Okay? So what I want to just do, I'll go over just a basic overview of what it is, talk about how you can play the game for real, and then see how that ties in. I think you'll appreciate how that connects. Okay, so there's the definition. It's meant to be an eye chart, so don't expect to read it, but it is pulled from their site, so you can actually tell that that's accurate. All right, and there's even more for you too. So basically the concept, and there's the actual link to prove it. The basic concept is this. The IRS says that if you have a property that you use for business or investment purposes, does not care land, does not care condo, does not care residential, doesn't care multifamily. As long as you have a property that fits that general criteria, if you sell it, don't touch the money, and then replace it with something else, equal value or more, you pay no tax on the capital gain. Well, and no recapture depreciation. Any accountants in the room? We had that last time. Any CPAs or accountants? You know what that's all about, right? Recapture depreciation. So that's one of those gotchas if you're not paying attention when you're doing one of these that can come up and bite you, especially if you have depreciated the property out. That's a 25% hit on what you depreciate. So what they're saying is if you do that, you basically have created no taxable event, is basically what they're saying. And it's delayed indefinitely until you actually, what Julian said, touch the money. You touch the money, you pay the tax. So that's basically the concept of the whole thing. Everybody got it now? You can now do the presentation for me?
No.
I'm just checking. Okay. So basically that's pretty much what it is. And I just went over the basics. You're exchanging typically one property for another to further tax. So you can sell an investment property by others of equal value. Does not mean they have to be though. You can do what's called a partial exchange. As Julian said, just keep it simple terminologies. Anything you do this with, you get the tax deferred benefit. Anything you do less of it, you're not going to get. So for example, you buy a property for $100,000, you sell it for $200,000. You're paying tax on the $100,000 gain. It's called gain, not income, by the way. Okay? Unless you're a dealer, that's another conversation. Then you cannot do exchange. If you're flipping if you're flipping properties, you cannot do exchanges. Does anybody know why that is? Nobody can answer that most times. I've learned this a long time ago because I wanted to know. Think in terms of what a dealer is. Think of a car dealer. What are they doing?
They're not holding the inventory.
The key word is inventory. Their product that they sell is treated as inventory. What is inventory? What do you have to do to make money with inventory? You have to sell it. You have to churn it. So a dealer in real estate is no different than any other dealer. You cannot exchange it because that asset that you're using, you're treating it as inventory. Inventory you pay tax on. You're not getting out of it. You're not delaying it, not deferring it. You're collecting it technically when it happens. And then with regard to real estate, you're paying it when you do your taxes next year on April 5th, due by April 15th. But think in terms of, isn't that a nice way of explaining that, right? So it goes by how you treat the property. For example, that property that Julian bought for $60,000, it was an investment for him. I buy it, I live in it, it's not an investment, it's my primary residence. It's still the same property, right? Didn't change. Maybe I fixed it up a little bit, but in effect, it's the same property. He treats it like an investment, I treat it like my personal residence. Two totally different tax treatments when we do our taxes. So it's key about how you treat the property, not what the property is. Make sense? Go ahead.
How long does he have to keep the property to do a temporary exchange stuff?
Great question. Assuming he's not a dealer in flipping them, okay? There is no specific time frame, but I always operate on the conservative side, because the IRS is the IRS, okay? Fact. Let's not, you know, I don't always want to push any gray area. That's why I appreciate what he said. Keep it as clean as possible. So, that being said, the typical termination, or typical time to think about is the longer the better. What the IRS will do is say, okay, let me look at what you did with that property. What was your intent when you purchased that property? The intent was to sell it. I don't care how long you've owned it. That is not exchangeable, period. You're using it like inventory, okay? If you go through all the motions, and this is how my attorney explains it to me, you're going down the path of an investor. What does an investor do? What do you want to do when you buy them if you're an investor? No, I'm not talking a flipper, I'm talking an investor. You're holding that, like he just said, how long do you hold it, right? What is your mindset when you're buying to hold? What is it?
Rent it out.
Right, rent it out as fast as possible, right? List it with a realtor, get it rented, fix it up, go through all those motions that you would. Put in the paper, list on their MLS, whatever. As long as you can show that, then you're proving to the IRS that you're treating it like an investment, okay? I talked to the IRS myself on this issue. She said to me, there was a girl who called me right back, which is awesome. She said, you could buy a property beginning of February, for example. Go through all those motions we just talked about. If somebody approaches you and says, you know what, I'd love to buy your property. And you know a couple of years ago that was happening, right? The inventory was short, properties were going crazy. You decide to change your path now, you want to sell it. You can technically sell it after owning it a month and do an exchange on that because you did these things. My attorney, which is very conservative like me, says, great, but don't do too many of those. Okay? The safer bet that you hear in the industry is hold it for a year. Can anybody tell me what happens at a year of ownership?
Short-term, long-term capital gain.
Thank you. Thank you. It switches from ordinary income to 15% now. If they change it, they'll change it up, probably. Okay, think in terms of that. What are you saying to the IRS now? Now it's looking and feeling more like what? An investment. You're holding it. It's now a year into the game. You're obviously looking like you're going to be using it as an investment. Okay? So there is no hard, fast rule on that. I would take it case by case, go conservative, without a doubt. If you're a dealer in most cases, and you want to do one like that, be very careful with how you document yourself when you're reporting to the IRS. You want to be working with your accountant early in the game on that one. And get everybody up to speed. Don't wait till you do a transaction, then go to the accountant and go, hey, make this good for me. It's already done. There's not much they can do, usually. Okay? Thanks. Did I answer your question? Long-winded, but I wanted to make sure you get the point, because that's really what's going on there. All right? So back on the exchange part, they changed the rules a lot over the years. Basically, it's like this. You sell the property, closing day starts the clock. You have 180 days to close on enough properties to use up the money that you sold for. Okay? That's the key. And I can tell you, no matter what market we're in, that's not a lot of time. Whether in a buyer's market, seller's market, doesn't matter. It's very annoying if you're not prepared ahead of time. Go ahead.
You used to have the other property already, or go, in line, ready to go before you could do this. Has that changed?
Absolutely, you do, but the way you do it is up to you. Okay, let me explain that. I recommend that the second or the time frame, very short period of time that you decide to sell, and you're thinking you want to buy something else, you start lining up the properties immediately. The IRS says the day of closing starts the clock. Before that, there's no clock running, it doesn't matter. Okay? Closing day starts the clock. You have 45 days to get back to me if I'm holding the money for you, which I'll get to in a second, how intermediaries work. But you have 45 days to get the paperwork to your intermediary that says, I'm looking at these specific properties to close on. You can do up to 3 without restriction. Okay? I recommend you do at least 2. Because what if one falls apart? So
And how long do you have to close?
180 days. It's a time frame within a time frame. It does not change. It doesn't matter if we have a holiday. Okay? If it's 4th of July, for example, and that's your 180th day, it's got to be finished before that. The only time I saw a grace period was after the hurricanes, when all the IRS deadlines got delayed. You know, it was like a relief situation. But don't rely on that, obviously. Okay? So that's what it is. It's 180 days total to finish it. You can do it in one day if you like. You can do an immediate or simultaneous exchange if you want the same day. Okay, but it's all about planning ahead of time. As soon as you want to do that, you sit down with your team, get your accountant, your real estate agent, whoever's working with you on the same page. Here's what we're trying to do. What I like you to do is think in terms of the strategy, because how you decide which properties you're looking at gives you some flexibility. Okay, but a couple of the main factors here. Like any tax deferred situation, you cannot touch the money. 401k, you see that same thing. IRAs, they don't want you touching it. It's called a constructive receipt, which means you now have control of it, so now it's taxable. You go down the street, you buy any product, a stick of gum, you pay tax immediately, right? As soon as the transaction happened, the tax is due and owed. So this is the way you delay it, as long as you don't touch it. You can't say, well, I'm going to open up a separate bank account, I'm not going to touch it, it's just for this transaction, the penny will match the closing statement, doesn't matter, you've touched the money, it cannot be yours. Okay? That means that you have to hire an intermediary, accommodator, facilitator, they're all the same thing. Some third party that's disinterested, that has not have done business with you in the last 2 years, and is definitely qualified to be able to handle this and handle the paperwork correctly. But it's somebody else holding the money for you in the transaction. So what happens is, you sell the property, closing, everything goes as normal. The cash at the end of that settlement statement on page 1 there gets wired or checked right to the intermediary account. They hold it temporarily until the transaction is ready to close on the other side. It could be the same day. Well, typically if it's the same day, it won't get wired and go right to the other closing, but that's how it works. And they send it out for the purchase. The transaction's over. The exchange is done. Okay? Any questions on that? Everybody got that? Pretty straightforward, right? Okay. So why do it? Couple obvious reasons. People said to me, I'm only deferring until I sell. What if I don't want to sell? What if I don't want to keep real estate anymore? Well, then you're going to pay the tax. But if you think in terms of strategy, like Julian said, you're talking retirement, and I want you to think past retirement to multi-generational wealth. You've created a cash cow, let's say, a portfolio that over the years you might have started like Monopoly with the one greenhouse. Okay? You build it up, 4 greenhouses, what happens? You go to the hotel, right? In the real world, you pay tax every time you sell those, if you make money on them, right? You keep exchanging them into the hotel. Now you have a bunch of hotels around the board. What happens when you have a hotel in St. Charles Place? The rent is more than they started with in cash when they started the game. Okay? So you can win the game with the smaller price properties, and I think that's the same message here. If you think in terms of that, you can build this up. So let's say you have a bunch of hotels, and you're ready to retire, or you're ready to pass it on to the next generation, or God forbid you pass away, and the next generation gets it. Why sell it if you don't have to? You've built this nest egg, let it continue. And the way this works, the actual next generation gets a stepped up in basis, get a little bit more complicated in tax questions, you can go over that with your accountant or your estate planner. But the nice thing about it is you don't have to pay the tax, it just continues indefinitely. And the stepped up in basis, you might have paid $100,000, the properties are now worth $1 million, because you've done this, you've held it for a bunch of time. They get it at the current value. So now it might be $1 million for them, starting with them at $1 million, whereas you would start at $100,000. Very, very powerful stuff. It's not taken away what Julian said, by the way. These are multiple tools. Okay? This assumes that you haven't done the IRA, you didn't know about it, didn't work for you, whatever reason, doesn't matter. Now you want to actually start taking a lay of the land of what you have right now and make the best out of it. Some of them might be an exchange, some of them might be an IRA. You might work to get them all IRA. Okay? But think in terms of using these tools when they benefit you. That's what they're there for. These are not loopholes. This has been in the tax code since the 1920s. One of the first things written in there. Okay? So
then what factors would you use to determine, should I go IRA or go 1031? You're listing your life.
Yeah, they're two different animals.
Okay, so how do you determine which animal you go with?
What I recommend you do is you sit down with your team, tax professional, tax attorneys, your other attorneys who have planned your estate, and you make that conversation. Put everything on the table, just like scatter everything there, and you weigh the best options at that time based on the goals that you want to have. Really. Julian said it right, they're different animals. So if you wanted to get all tax-free, there's restrictions in what he's doing, just like the restrictions in here. All of them have them. So you've got to sit down with your team, as I would suggest, as early as you can, to figure out a game plan. And as your life and your situation change, then you can make that call.
I don't have a team.
Well, it's time to go.
That's okay.
It doesn't sound like you don't. It doesn't sound like you have. I think you have a team.
There's no team there.
I think you're kidding.
You can do both of these strategies, but never with the same property. Okay, like if you have an IRA, you can't do a 1031 exchange.
But you know what's funny? The IRA can partner with the 1031. So we're getting a little advanced now, but let's think in terms of what he said. You know, everybody understand tenants in common? Anybody does not understand what that means, please just let me know, because I don't want to skip over if you don't know that. It's basically two people that are not related own property, right? So what happens is, think in that same definition, I want to buy, my exchange is I'm selling property for 100,000. I want to exchange it, but I want to buy something more than 100,000, and I don't want to go to the bank for that. I go up, somebody else has an IRA, maybe he doesn't want to loan money, but maybe the IRA wants to own the property. Put the two together, tenant common IRA, tenant common exchange, and whoever my entity was that I exchanged into. So there's a lot of creativity here, and again, it's not for every transaction necessarily, but you talk to guys like us or anybody you're comfortable with, and definitely plan it out ahead of time and see it. Sometimes it's just whatever you feel is the best situation for you. It's not necessarily black and white all the time. So
You can use an LLC.
yeah, the key to remember, just like Julian said, was it's whoever owns the property, whoever's the tax-paying entity, the tax ID that's going to be filed in the tax return gets the benefit. So if it's an LLC, it's a single member, it's you because it's disregarded, right? So if it's a multi-member, then it's that entity. And if you think in terms of partnership, we're starting to get advanced stuff, but if you think in terms of partnership and you want to start maybe branching out, then you need to break the LLC up because that cannot be broken on a 1031. You want to do that ahead of time. So again, it's about, and you know what, it doesn't hurt to maybe sit down with a team that you're going to assemble after this meeting. You know, maybe once a year or as necessary. Just to check bases with somebody, your accountant, bring somebody in, that kind of thing. All right? So you're going to do this indefinitely, as I said. And why not if it makes sense, right? Time value of money, everybody understand that with inflation, right? So if I'm saving money today, and I don't pay the IRS $20,000 from this transaction, and I have that much more to reinvest into that thing, and I'll give an example. If you're selling for $100,000, that's $15,000 capital gain if you own it more than a year, as we just said, right? And if you recapture depreciation, that could be another $5,000, $10,000, depending again on what you've recaptured, or what you've depreciated. All of that gets saved and now reinvested what? Back into real estate that you made a better deal. Can anybody tell me when you make money in real estate? Trick question. Thank you.
When?
When you buy. When you buy, not when you sell. So if you're buying them, time value of money with today's dollars, you just think what you do. You anticipate, you got ahead of the inflation. Okay? So that's kind of how to think about that as well. Redistribution of assets. Anybody have assets that were great and now they're not doing so well?
Everyone.
I'm not even going to say that. You don't want to hear what you just said. Okay? Great idea to use exchanges when it makes sense. Maybe you don't have them in the IRA, right? And now they're not doing so well, but you see that area over there is hot. Or maybe you don't like the single families, you want to get to multifamilies. Or maybe you don't like multifamilies, you want to get back to single. Doesn't matter. You can take this, sell them, put it in through the exchange, and now the IRS is allowing you to redistribute your assets. You still have closing costs, right? You still have marketing, you still have commissions. But the taxes are usually the hugest chunk, and you don't have to worry about that, okay? Because it's allowing you to do that legally, all right? Building multi-generational wealth, I already discussed that. That is absolutely huge. You need an advanced team for that. You don't have to get them tomorrow, but think in terms of that, okay? So let's just talk about nothing. No, I'm just kidding. Let's talk about how. How are we doing for time, Kristin?
We got about 10 minutes.
Oh, okay. So let's talk about this. I already mentioned. You got your 3 greenhouses. Actually go to 4. Then you go to the hotel. Or you go the other way around. Don't think that you're stuck. That's the beauty of it. Okay? And as I said before, if you're thinking, let's say all your properties are on your own name, which I don't recommend, especially if you're going to be more and more of building your nest egg, right? Put them in the IRA, put them in LLC, as he said, whatever. Think in terms of sitting down with somebody who knows what they're talking about. Attorneys, accountants, all right? And definitely set up something so that as you're moving forward, you're already making the right steps. And don't worry about making mistakes. The fact that you're focusing on is half the battle. Most people don't do this, and then you got problems down the road once you already own these properties. Yeah.
The property's already in your own name.
Yeah.
If you want to do a 1031, but if you want to now start buying properties in LLC, it's not complicated matters because you're doing a 1031 exchange from your own name to, you know what I mean?
Is the LLC single, or is it multiple?
Well, I'll be saying it's single,
Right.
single LLC, but I have a property that's already in my own name.
Right.
So if I want to do a 1031 exchange, and, you know, is that?
Yeah, good question. Everybody understand what he's trying to do? The key to remember is the exchange has to be the way it is when you do it. You cannot do it in the middle of. Absolutely cannot do that. So anything you're going to be doing, changing ownership, title, whatever, do that as far before the exchange or far after the exchange as possible. You don't want to be changing around equity positions and stuff before an exchange. Yeah, it's very cut and dry with the
If you think
IRS.
about doing 1031 exchange
Yeah.
next year, buying another property that you own this year in your own name, you should do a quick claim or something to an LLC or something like that so you can change ownership.
If that's your strategy, that's what you want to do.
Yeah.
You want to make sure when you do that, you
That's
don't,
consequence of that?
well, you got to make sure, again, you got to make sure, there could be.
Seventeen.
You could be.
The
You
team.
do, you really do. It's right on
Yeah,
the
you
team.
can't just, sometimes it sounds simple on paper, I'm just gonna do a quick claim deed, I can buy that at Home Depot, right, or Office Depot. Buy a quick claim deed, write it up, don't recommend that. Sit down with a professional that's been doing it for a while, that knows what they're talking about, and then don't be afraid, for example, like, I'll give you an example, how big do you think the tax code is? Huge.
19 million pages.
How much?
19 million.
That's close. I think you're off by $1 million, no, I'm just kidding. So the point is, if you go to an account, they're expected to know all of it, right? They can't. So understand that there's people that focus on different aspects of it. 1031 is probably a very small portion of it. For example, when I started my company here, I had asked my account to find me 3 top tax attorneys in South Florida. I wanted to talk to them about 1031s and see what they knew about it. All 3 of them deferred me and said, we really don't focus on it. We really couldn't help you. I was shocked. So I already had a guy I was making to see if I could find other people as my team, as backing up. And these 3 gentlemen got right back to me and they said, we'd love to, that's not our focus. And understand that, so you find a team that helps you with what you need at the time. If you're not big yet, then go with people that understand your deal and your nature of what you're dealing with right now. Make sense? Okay, so.
I did one exchange back in '04, make a long story short.
Right.
I'm considering doing a short sale on the house, now the property's around me. You're doing a short sale on a property that was already 1031 exchange done on it. Is that,
A great question. Everybody understand, obviously everybody understands short sales. Kristin just went over that, right? So the idea is you want to look at, forget about the fact that it's a short sale just for a second. You sit down with your accountant, if you don't have one, get one, okay? Or get somebody that you recommend, that can recommend things to you and bounce things off of you. So you sit down with them, it's all about the numbers and how you reported that property. Okay, you can actually short sale property and still owe capital gains on it, technically, right? If you think about it.
Yeah.
So it really, you can't answer that question until you know the facts. You need to lay it out and understand how you've been reporting on your tax return year after year as well. Have you depreciated? I mean, there's a lot of different factors that come in there. And I don't know how it relates to what she was talking about with that relief act, but that's a conversation you have, again, as early as you can prior to doing the transaction.
But you can do one. You can do a short sale after doing
Yes.
it.
Yeah. And remember, you're going to look at the impact all across the board. One impact is the debt. Another impact is the capital gains implication.
what account would you recommend, since you've gone 3 top attorneys that do it? Seriously, because the problem is sometimes you end up getting so many opinions and information
Right.
and misinformation. You're not sure which way to go, even with,
Yeah, we can talk after,
Yeah.
absolutely, we can talk after.
And
there's one in the
I've
house here too.
I mean, I've got great attorneys. I work with about 10 different
Exactly.
attorneys. I've got great accountants.
Exactly.
So, and you get a couple from different people, but I work with an accountant that does a lot of investments, that he's phenomenal too.
Yeah,
You
and,
get a couple people to talk to, like he said, like Drew said, you wanna get people that you feel comfortable with.
right.
But we only got like 3 minutes left for his.
So we're going to fly through this. The terms, you don't really need to memorize the terms. I just put it up here. Relinquished is the property you're selling, replacement. These are just industry terms. You really don't have to know that. We've already talked about a few of these. When you do an exchange, you hire an intermediary. Okay, you hire them, but they're not representing you. It's not like a real estate agent, even though you have transactional brokers and stuff. I mean, the bottom line is they're third party. You will get advice. You will get, not advice, you will get information about the rules, but they're not representing you. That's why you need the team. They're a third party. So you're going to have an agreement with them because they're going to hold your escrow. Okay? And you want to understand, just like any relationship, somebody holding your money, there's an agreement how that's going to play out. There's standardized agreements. I paid somebody to do that, again, to make sure that we were doing everything above board. And that's really what it is. The company is operating as an escrow account for you during that short period of time that you're actually doing the exchange. Okay? So here's some of the rules. We already went through a lot of these already. And we already went through types of properties. Again, it doesn't matter what they are. Commercial to residential, you can do that. Land to commercial, land to doesn't matter. It's, again, remember what I said in the beginning, how you use it. Make sense? Okay. Yeah, one other thing I wanted to focus on here is what makes a property qualified? how can you say, like you said, well, this was a 1031 property? What makes it a 1031 property?
Like kind.
Like kind is what they call it, and they only call it because it's all real estate, it's how you use it. It qualifies how is it used. Okay? That's why you can buy a property from somebody who has no idea what a 1031 is, because it's still a regular real estate transaction. You're going to just find the intermediary on the settlement statement in place of you as the owner, because they're actually receiving the proceeds of the owner at the closing. But there's no obligation, there's no title, they're not getting involved in that. Okay? And then, we went through this already. Timelines and strategy. Let me just touch on the strategy and then we'll finish up. Here's the strategy. So, they basically have up to three properties, I said, you have to identify, right? But the way you do that depends on what you're looking for. So for example, if you're going from one property into multiple, you're going to need more than three, right? You're going to need several because you need backups. The IRS will allow you to do that, but they're going to restrict what you put on that piece of paper. So that's more advanced stuff. Just remember, the strategy all is about what you're trying to do, and then we talk about how that rules apply to what you're trying to do. Okay? So understand there is a strategy behind this. In fact, identifying the properties is the biggest strategy of the 1031. Next to obvious, tax benefits and all that. But the strategy is what you do before you sell, because before you sell, the time is your own. You're not bound by any time. And that's the key. That's one thing you do control. All right? You might not be control when it closes, but you do control when you sell. Make sense?
Yeah.
Cool. Any questions for me? Go ahead.
I have a triplex and I live in a portion of that. How does that affect where, because it's my primary residence and I have 2 rental properties when I sell that property. How does the 1031 affect that?
I'm going to go back to you and say, how do you report on your taxes?
Okay.
And then you talk to your accountant about that. Is it 2/3? Technically, are you dividing it up? I mean,
about 49.51.
Okay, so you would take it in that kind of a way. We'd have to have your accountant take a look at that, but that's kind of how it would work. Keeping it simple. You want, again, as clear as possible to the IRS. Even though it could be 2/3, 1/3, make it as clear as possible. But good question. It makes sense when we say that, right? It goes by how you've been reporting and how you're treating it. How long have you owned it, by the way? Long time
15
ago.
years.
Yeah. So you've done a lot of depreciation probably, depreciating your side. Because remember, when you own your own property, you get that waiver of gain. That's separate from this. That's a whole other conversation. So you would be able to do both, but you have to be careful how you make sure you document it. All right? Anybody else?
What do you charge for?
$1,500 flat, and that's up to 3 transactions. Very, very, very reasonable. And the nice thing is, you don't have, you get a consultation if you want with the attorney. You get to pick your own bank where the money's held. I mean, it gives you back a lot that I've found works for investors. So.
Is the title company charging any now to?
Good question. Title companies, a lot of them have their own exchange component, but a lot of them don't do them regularly. So they kind of defer to people like myself or somebody else that does it full time or does it, a lot of time. But some of them do. Again, it goes back to building your team who you're comfortable with.
Okay. So I mean, because I've done one in 8 years, so I don't know. So basically, the title company, are they going to have a separate charge because we did the 1031 exchange?
I don't know how they would price it out, but typically there's a separate fee, without a doubt.
Do you do closings too?
No.
Okay.
Not attorney, not taxes, nothing, separate. I have a real estate license, I am a realtor, but separate. All right? And I could not do an exchange and represent your own property.
Right.
So, all right?
Thank you.
Okay.
Thank you guys.
Thank you.
Thank you. Hope I lived up to the description.